Hey everyone, it's Julie here with Tip Ranks. Today, we're taking a look at 3 stocks that hedge funds have been buying the dip on. So let's get into it. All right, guys, welcome back. Thank you all so much for being here. Today, we are taking a look at 3 stocks that hedge funds have been buying up as the stock price has been dipping this past quarter. And when I say buying, I mean they've been adding millions of dollars worth to their holdings. So today, we're going to take a look at these companies, what it is that they do, and of course, what those Wall Street analysts have to say. And you guys know I love my analyst ratings there, so of course, all of today's stocks also are rated a strong buy. I found them using TipRank's stock screener. Found underneath the screener menu, here I put in a few filters, including double-digit upside, a strong buy consensus, and then under add filters, I included hedge fund signal, which of course we want it to be positive, and that narrowed down our list of companies below. You can try the stock screener for yourself on the TipRanks website or right on the TipRanks mobile app. Links to download are in the description down below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Now let's dive right into today's stocks. First on the list, we're taking a look at Ouster. They trade under the ticker OUST, currently priced at over $25 per share. Now year to date, the stock has seen big gains, climbing over 100%, but more recently, it is down 17% in the past 3 months and is down 30% from some of these highs. Ouster is a San Francisco-based technology company specializing in LiDAR sensors. They develop high-resolution digital 3D LiDAR hardware and software solutions that enable precise environmental mapping and perception for machines and systems. Their sensors are designed for applications requiring advanced 3D vision in dynamic environments. Their primary industries include automotive, industrial, robotics and drones, plus defense and security. They shared their Q3 earnings report at the start of November, where they did have a narrower than expected loss, plus saw record revenue and sensor shipments. They reported a loss per share of 17 cents, which was 1 cent better than analysts anticipated, and revenue climbed to a record $39.5 million, which represented 41% year-over-year growth and shipped over 72 sensors, an all-time high. The company also ended the quarter with $247 million in cash and equivalents. And as the stock has dipped, we've seen several hedge funds start brand new positions, with overall holdings increasing by 2.5 million shares. And that includes 5 brand new positions in the stock, including the likes of Dry House Capital, Slate Path, and Ray Dalio's Bridgewater Associates. When it comes to Wall Street analyst ratings, the Ouster stock does come in as a unanimous strong buy with 5 current ratings. And the average price target of $37.40 implies an upside potential of 46%. Looking at those price targets down below, all in the double digits here, ranging from an upside of 29% to 56%. Second on our list today is Corebridge Financial. They trade under the ticker CRBG, currently priced just above $30 per share. Year to date, the stock is in the green, having climbed 5%, but is in the red more recently and is down nearly 10% in the last 3 months. Corebridge provides retirement solutions and insurance products in the United States. Spun off from AIG back in 2022, they help millions plan and protect their financial future with annuities, 401ks, life insurance, and institutional products. Managing over $365 billion in assets, Corebridge focuses on delivering secure retirement income and lifelong financial confidence through a wide range of individual and employer-sponsored solutions. They also shared their third quarter earnings report at the start of November. Now they did fall short on earnings, but had a revenue beat and noted record capital return. Their Q3 earnings of 96 cents did fall 12 cents short of analysts' expectations, while revenue climbed 24% year over year to $5.63 billion. Year to date, they returned more than $1.4 billion to shareholders through buybacks and dividends. That current quarterly dividend is 24 cents per share for a yield of 3%. And as you know, hedge funds have been buying up shares, increasing their holdings by 2.8 million shares last quarter. And that is comprised of 1 brand new holdings from Bridgewater Associates, plus an increase to an existing one, bringing it up to $715 million. Now, we have seen some analysts slightly lower their price targets due to anticipated Fed rate cuts, but with 7 buys and 2 holds, Corebridge does still come in as a strong buy. And the average price target of $38.75 implies an upside potential of 26%. Looking at those price targets down below, they range from a low-end upside of 7% with a hold rating here to one above 43%. You guys know the deal. If you've made it all the way to our third stock today, then make sure you've hit that thumbs up button. Third on our list, and with the largest hedge fund activity, is DraftKings. Trading under the ticker DKNG, they're currently priced above $34 per share. They are down 16% overall in the past year, and in the last 3 months have fallen about 24%. DraftKings is a well-known name in sports entertainment and gaming. They started as a daily fantasy sports provider and have grown into a major player in legal online sports betting and iGaming across the US and Canada. They operate a top-rated sportsbook app, online casino, and fantasy sports platform in over 25 states, offering betting on NFL, NBA, and more, plus casino games like slots, blackjack, and live dealer tables. As you saw, the DraftKings stock has been under pressure this year. Part of that is due to their third quarter earnings report on November 7th, where they did fall short on both earnings and revenue and lowered their 2025 revenue outlook. They reported a loss per share of 52 cents, which was 9 cents worse than anticipated. And while revenue did climb a few percent year over year to $1.14 billion, it did miss expectations by $60 million. They did secure exclusive marketing agreements, and their customer retention rates improved significantly, but the company did revise their fiscal 2025 revenue guidance downward by about $3 billion and reported negative $127 million of adjusted EBITDA, primarily due to unfavorable sports outcomes. But despite these headwinds, we have seen a massive increase in hedge fund activity, with hedge funds increasing their holdings by 15.2 million shares last quarter. That is a combination of new and increased positions, with Viking Global's taking a new position of 561 million, Bridgewater Associates increasing their position, and another big increase to 234 million with Eminence Capital. And looking at those analyst ratings, DraftKings has 28 current analyst ratings, 23 rated a buy, while 5 rated a hold. And the average price target of $44 implies an upside potential of nearly 29%. Looking at those price targets down below at the most recent ones, on the low end we do have a hold with a downside of 12%, while on the high end we have a buy rating with an upside of 62%. So that is a quick look at 3 strong buy stocks that have dipped in price recently and have seen a big increase in hedge fund activity. Let me know your thoughts on these companies and which one catches your eye the most. I always appreciate hearing from you guys. Keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always stick to your own investment plan. Thanks so much for watching. I hope you have a wonderful day, and I'll see you back here next time.